Today I'm sharing with you 4 high yield dividend stocks. Each of them are sitting at their 52-week low, despite 3 of them beating their earnings within the last few weeks. Now each of these companies have a dividend yield above 3%, with the last one on our list above 4%. So being at a great discount right now, they're perfect for you to add to your portfolio. First company on our list is in the financial sector. It is Bank of America, ticker symbol BAC, and it had its earnings on April 18th, and it beat its earnings over 16%, and it beat its revenue nearly 5%. Now from the start of the year, it has fallen over 17%, and with this last month, it has fallen 0.25%, bringing it to a current share price of $27.71. As mentioned, it is at its 52-week low and is trading at a PE of 8.10. It has a dividend yield of 3.18%, which will give you an annual payout of 88 cents. Looking at the average free cash flow it had over the last 5 years, comparing it with how much it pays in dividends, Bank of America can definitely afford paying its dividends to shareholders. One other thing to look at the market cap, $223 billion, and comparing it to its enterprise value of $1.9 trillion. Comparing the two will show that the company does have a handful of debt. Over on the income statement, we're looking at the revenue. This last year, it did have a nice spike up. The previous years, it's been around the high $80 billion and low $90 billion. So has been pretty stable. Right down here, looking at its net income, Bank of America the last 2 years has had a jump up compared to what it previously had, and also in 2019 it had a jump up. Versus earnings per share, we can see that last year it did have a big spike up, but this year it's starting to go close to what it had previously. As for shares outstanding, Bank of America is buying back shares, and it is increasing its dividend year over year, which is great to see. Wall Street analysts are considering Bank of America as a strong buy right now, with a low of $28 and a high of $47. That'll bring its average price target to $36, and that's about a 30% upside from its current share price. Now, as far as analyst estimates, they do see a slight drop in 2026 in net earnings per share, but increasing from then. And as far as revenue, they see the revenue increasing over the next 5 years. As far as my estimates go, looking at the historic values right here, I'm doing a revenue growth of 1, 2, and 3%, profit margin of 2022 and 24%, free cash flow margin of 24, 26, and 28%, PE and price to free cash flow as 10, 12, and 14 with 10% return. So scrolling on here, based on these assumptions, the current share price is between my mid and low. The price target I really look at is around $30. So right now, I do think that Bank of America is at a great buy, being at $27. Over on the weekly chart, we can see that Bank of America has had a spike up right after it had earnings, but it's been staying around that 52-week low for the last month or so since the big drop in Silicon Valley. Now, as I mentioned, it did have a spike up right after its earnings, but within the last few weeks, it has fallen back down to what it has had throughout April. So it is sitting below all of its moving averages, and its momentum is pretty stagnant right now with a negative trend and at an oversold section. Next company on the list is in the healthcare sector. This company is CVS Health Corporation, ticker symbol CVS. May 3rd, it had its earnings, and it beat its earnings by over 4.5% and beat its revenue by 0.6%. So great to see for CVS. Now with the start of the year, CVS has fallen nearly 24%, and over the last month it has fallen 8%, bringing it to a current share price of $70.68. So as mentioned, it's sitting right on its 52-week low, is trading at a PE of 8.14, has a nice dividend yield of 3.4%, which will give you an annual payout of $2.42. Looking at its 5-year average of free cash flow of $11.9 billion, it can definitely support its dividend yield, paying $2.9 billion yearly. Now comparing its market cap of $95 billion with its enterprise value of $236 billion, it definitely has a good chunk of debt within the company right now. Over on the income statement, looking at its revenue, so you can see here that year over year it has continued to increase its revenue year over year. Going on here for its net income, the last few years it was increasing its income. However, this year it did have a big drop right there, as you can see. Scrolling on here for its earnings per share, just like its income, its earnings per share did drop this last year, but it was increasing the last couple of years. As far as share buybacks, the last few years it pretty much stayed the same with everything in 2020, but it's starting to buy back shares again, which is nice to see, especially since it's at its 52-week low, a good time for the company to buy discounted shares. And it's great to see that they are increasing their dividend year over year. Wall Street analysts are considering CVS as a buy right now with a low of $86 and a high of $143. That'll give you an average price target of $106, which is about a 50% upside from its current share price. As far as analyst estimates, they do see the earnings per share increasing within the next 5 years, 8.9 to about 13. And the same for its revenue increasing over the next 5 years, going from $337 billion to $374 billion. As far as my assumptions, looking at its revenue growth, I have 7, 9, and 11%. For profit margin, I have 1, 1.5, and 2%. As for free cash flow, I have 2, 3, and 4%. And as for PE, I have 14, 16, and 18. And for price to free cash flow, I have 7, 9, and 11 with a 12% return. Scroll on here, we can see that the current share price is right in between my low and mid, and a good price target I think is for CVS is below that $80 range. Currently, CVS is sitting at a good price in my opinion. Now for CVS, it really had a big fall through all of its moving averages back in February, and it's been hovering around that $70 range. We can see that his momentum is negative and it has a negative trend right now, just hovering in that oversold section. Over on the daily view, you can see that it has just been trailing its 9 and 25 day moving average and did have a big drop back to its 52-week low after earnings on May 3rd, and is still sitting in a negative trend. Next company listed is also in the financial sector, and this company is MetLife, ticker symbol MET, and primarily is one of the largest companies for life insurance. Now on May 3rd, MetLife did have their earnings, however they did not beat their earnings like the other companies we've gone over today. They failed their earnings by over 16%, and they also failed their revenue by over 8.5%. Since the beginning of the year, MetLife has fallen nearly 24%, and just within the last month it has fallen over 5%. Bringing it to a current share price of $54.66. It is at its 52-week low and is trading at a PE of 6.91. It has a nice dividend yield of 3.81%, which will give you an annual payout of $2.08. Now MetLife does have a 5-year average of its free cash flow of $12.5 billion, and every year it pays $1.7 billion in dividends, so it definitely can support that dividend payout to its shareholders. Now one good thing to see here is that its current free cash flow is pretty in line with its 5-year average, so that's a good sign to see. Now looking at its market cap of $44 billion, comparing it to its enterprise value of negative $238 billion. Once again, this difference is the debt that the company has, so I'm being with in the financial sector, the kind of debt works a little differently than other companies. Over on the income statement, looking at its revenue, in 2021 and 2022, it did drop back to what it previously had before 2020, but right now it has had a jump up this last year to what it had in 2020. So nice to see it's increasing since then. Scroll down here to its net income. Now it is interesting to see that it had a drop in 2021 and is currently back close to that range with the fall from last year. Scroll down here for its earnings per share. Income statement did have a fall from last year, being $7 to just over $2 this year, which is under what it had prior to 2020. As far as shares outstanding, it is buying back shares, as you see right here, which is nice to see since it is at its 52-week low, consistently increasing dividend growth, so that's great to see. Wall Street analysts consider MetLife a buy right now, with a low of $60 and a high of $85, with the average price target of $75, which will give you about a 37 upside to its current share price. Now, as far as analysts' estimates, they do see after 2025, there will be a dip in its earnings per share, as you can see right here. However, as far as the revenue, they see it consistently growing over the next 5 years, from 70 billion to about 80 billion. Now, as far as my assumptions for MetLife, I have a revenue growth of -2%, 0%, and 2%, profit margin of 2%, 4%, and 6%, free cash flow margin of 16%, 18%, and 20%, PE of 12, 14, 16, and price to free cash flow of 1, 2, and 3, with a return of 12%. Scrolling on here, you see that the current share price is right in between my low and mid assumptions, and I think that around that $65, $60 range is a good time to consider adding MetLife to your portfolio. Over on a weekly view, we can see that there was a big drop of MetLife around that Silicon Valley time, and it's been trying to push through its 200-day moving average since then. Right here you can see within the last week, once it had its earnings, there was a big drop again, after it was getting some nice volume to push it through its 200-day moving average. So we do have some negative momentum, as well as a neutral trend right now in its oversold section. Now, as I mentioned, looking at its daily view, it was starting to have some positive momentum, moving back through its moving averages, but right after its earnings, it just had a drop back to its 52-week low. So its momentum right now is starting to stagnate, still at a neutral trend and moving downward towards the oversold section. This next company is also in the healthcare sector, focusing on pharmaceuticals. This company is Pfizer, ticker symbol PFE. Now on May 2nd, Pfizer beat its earnings of nearly 25% and it beat its revenue of over 10%. So great to see for Pfizer. Now from the start of the year, although Pfizer did beat its earnings of 25%, it has fallen nearly 25. And within the last month, it has fallen 8%, bringing it to a current share price of $38.49. Now Pfizer is sitting at a 52-week low and is trading at a PE of 11.4 with a nice dividend yield of 4.26%, which will give you an annual payout of $1.64. Now Pfizer does have a 5-year free cash flow average of $18.4 billion with the current one of $26 billion. So with that, it definitely has enough free cash flow to pay $8.9 billion in dividends to its shareholders. Now looking at its market cap of $216 billion and comparing it to its enterprise value of $295 billion, there is a good chunk of debt within Pfizer right now. Over on its income statement, looking at its revenue, you can see here that it's had a big jump up over the last 2 years compared to what it had previously, and that big jump is most likely due to the COVID vaccine. So we'll have to see if it can sustain that nice increase in revenue coming forward. Scroll down here to its net income. Just like its revenue the last 2 years had a nice spike up in income compared to what it previously had. So we'll have to see if the company can continue on that trend going forward. As far as its earnings per share, it has continued to increase its earnings per share. And as far as its share buybacks, it has been, the last 2 years, it has increased some of its shares. And as far as dividend growth, it has been increasing its dividend year over year, which is great to see. As far as Wall Street analysts, they do see Pfizer as a buy right now with a low of $39 and a high of $75, which will bring you to a price target of $47, which is about a 24.5% upside from its current share price. Now, analyst estimates do see an increase in Pfizer's earnings per share. However, in the next 4 to 5 years, kind of stagnate a little bit. Now, as far as its revenue, analysts do see in 2025 a little dip right here. So going from $69 billion to $72 billion and back down to around $71 billion. Now, as far as my assumptions for Pfizer, revenue growth of 3.57%, for profit margin 24, 26, and 28%. For free cash flow, across the board I have 28% because looking at its history value is pretty much stable right there. As far as PE and price to free cash flow, I have 6, 7, and 8 with a 12% return. Scroll down here, we see here that the current share price is between my low and mid assumptions, and I think a good price target for Pfizer is below the $44 range. At its current share price, I think Pfizer's at a good buy right now. Looking at weekly view, in early March, Pfizer did have a nice spike up, but since then it has been falling back to that 52-week low. So it has some negative momentum right now and is in a negative trend, being in that oversold section. Now, as far as the daily view right now, you can see that Pfizer has been bouncing between that $38 range and that $40 range. So its momentum is pretty stagnant right now and is still in that negative trend. And right after earnings, it did drop a bit, about $1. So there you have it, 4 great high dividend yield stocks that are all at their 52-week low, and a good time to consider adding to your portfolio. If you enjoyed this content so far, let me know by smashing the like button and drop down in your comments below if you have any of these stocks in your portfolio. If you like to look for more stock analysis, check out this video right over here and I'll catch you over there. Have a blessed day. Peace.